Tansy, are we live? Did it kick over?
Yep, you're live.
All right, great. Good afternoon and welcome everybody. My name is Dean Moran. I am the Northeast Divisional Manager here at Guaranteed Rate. And I'm happy and thrilled that you were able to make this call today. Along with me, I have my boss, John Palmiato, who's the Chief Retail National Production Manager, here with us today. So JP, great to have you here on the panel with us today.
Great to be
here.
And
also we have Sean Panosian on the panel with us today, SVP of Sales and top originator in the country. Sean was personally responsible for helping to facilitate today's call. So Sean, I just want to extend my appreciation to you for getting us together with Barry and making this happen.
Of course, we got the best in the industry, in my opinion, at mortgage rates and very relevant information. So I'm excited to have Barry share his information with everybody.
Yeah, definitely. And we have almost 1,000 people that we're expecting to be logging on today. So a lot of people are definitely interested in hearing what Barry has to say, regarding this crazy market that we're in. I just want to give a little bit of a bio on Barry Habib. And, so Barry Habib is the CEO, as most of you know, of MBS Highway and an industry expert on all things that are real estate related. He is considered the industry's most highly regarded and recognized MBS Highway rather is considered to be the industry's most highly regarded and recognized tool for transforming salespeople into advisors. And it has really kind of become like the Bible for many loan officers in the industry today. He's also a #1 bestseller with Amazon on his book, Money in the Streets. He makes frequent appearances on CNBC and Fox News. And also, fun fact, he's a 3-time Crystal Ball winner by Zillow and Pulseonomics for the most accurate real estate forecast out of 150 top economists in the United States, which is really incredible. In 2019, Barry was named Mortgage Professional of the Year by National Mortgage Professional magazine. And also in 2019, he was a finalist for the prestigious Ernst & Young Entrepreneur of the Year Award. So he was named recently to the esteemed Mortgage Global 100 list for 2021 by Mortgage Professional. And during his mortgage sales career, Barry personally originated over $2 billion in closed business, which is truly a remarkable number. During his spare time, he was a lead producer and managing partner for Rock of Ages, which was the 27th longest running show in Broadway history. And didn't know this one, Barry also produced Chris Angel's Mind Freak. Many of you may have seen that at Planet Hollywood in Vegas. I remember watching that and was truly blown away by that one. That was incredible, Barry. I didn't know that. Well, and a few other things. Barry is also considered the highest rated speaker and trainer for over 25 years in mortgage and real estate. And his Certified Mortgage Advisor course, also known as CMA, is renowned for elevating the professionalism and mortgage knowledge within the industry. And as an innovator, I think this really speaks to Barry's career, he's founded many successful businesses across many different verticals in real estate, healthcare, technology, which would also include experience.com. So Barry, on a personal level, I really want to thank you again for agreeing to speak with us here today and for sharing your insights in this market that we're all currently involved with. We have last count was over 700, but I'm hearing now it's going to hit 1,000 people that are live streaming this from home, from work, as well as doing some real estate events with luncheons and things of that nature. Everybody is very, very excited to hear about where we are, where you see us going, what the future may hold. There's a lot of rumors, there's a lot of speculations, and we're hoping to really kind of get dialed in today here with some of your opinions.
Well, Dean, thank you so much. John, appreciate you having me here, and my dear friend Sean, it is an honor to be here with all of you. And anytime you get to chat with my friends at Guaranteed Rate and Guaranteed Rate Affinity Groups and the friends and really family that I consider you guys to be, it is absolutely a privilege. And Shant, it is so great to be with you. You're the number one guy in the United States, man, which is an incredible accomplishment. You know, I thought I did some decent numbers in my career. You blow that away. You do what I did in my whole career in like a single year. So you're really Superman.
Thank you very much.
It's an honor and a privilege to be here with you guys. So listen, let's get started. I'll talk to you first. And gentlemen, if you don't mind, if you wouldn't mind, please just muting. What I'm going to chat with you guys about today is this current market in a lot of different aspects, because there are fears with regards to the real estate environment. There are fears of potential housing bubble. Where are mortgage rates going to go? Some people say, oh, they're going to 10%. Let's break that down and take fear out of it, and let's understand factually what is happening in this marketplace, and also where this marketplace appears heading. So again, guys, if you don't mind, just please muting. You know, Dean, I don't know if you could just mute just so we can kind of, yeah, there we go. All right, so let's think about what are the driving factors here. So the real estate market right now is being impacted by higher mortgage rates that are keeping buyers on the sidelines. But the inventory situation is still very tight. Now, when we take a peek at where mortgage rates are headed, we have to understand what drives mortgage rates. Because I believe right now is one of the greatest opportunities in real estate, the greatest opportunities for wealth creation. I'm going to take the next hour and I'm going to show you why, but I don't want to just show you why so you understand it. I want to show you why so you can explain it and so you can teach it. And I'm highly confident that this will be a game changer for you. So listen, please focus, pay close attention, take good notes, because you're going to want to review this and you're going to want to explain this, because every one of your clients needs to hear this and every one of your referral sources needs to hear this. Otherwise, they're going to look back and they're going to be one of these things like, oh, I missed it. Every opportunity is born from adversity. Everyone. I'm embarrassed to tell you how long I'm doing this and how many years I've been doing this, but I can tell you this: when people, just before it turns positive, people leave the business, people shy away from making purchases on real estate. This is the opportunity that you've been waiting for, and this is also the market that you've been waiting for. Whether you like it right now or not, and I know it causes some heartburn for you, but this is the market that you wanted, because this gives you the chance to outshine your competition and position yourself to gain market share going forward. And there will be a tomorrow. It's not that far away. There will be a market where things are a lot better. So right now gives you the opportunity to position yourself for it. So let's go step by step. First of all, mortgage rates. So what drives mortgage rates? It's not the Fed. The Fed doesn't have anything to do with mortgage rates directly. The Fed controls an overnight lending rate. That impacts a lot of things, but not mortgage rates directly. In fact, Fed rate hikes, by going up, can actually help mortgage rates, and it has done so in history if it's believed that what the Fed is doing is controlling what really impacts mortgage rates, and that's inflation. So the first thing to understand is that inflation drives mortgage rates. Why is that the case? Well, I want you to think about this. If you were now lending money, let's say you're giving me a mortgage, you're going to get a fixed payment back from me in just about all cases. Even if it's a hybrid arm, it's going to be fixed for a long period of time. So let's just say you're receiving a payment from me of $2,000 a month. You take your check that you got from me for $2,000 and you get a shopping list of goods and services. Now, on that shopping list of goods and services, you get everything on that list for the $2,000. Next month, you get another check. It says $2,000. You get everything on the list. But over time, you discover that you can't get everything on the list. And you know why. The reason is because inflation, because prices start going up. And now I got to leave a few things off. It costs more for these things. So the check still says $2,000 every month, just doesn't buy what $2,000 used to. It's eroding in its buying power over time because of inflation. Now, when inflation is very low, and look, a year ago, what was inflation? 1%, right? Remember when the Fed wanted more inflation? At 1%, there's a tiny bit of erosion. So I'm not worried about erosion in my buying power. So therefore, I can offer you a low rate. But now, because inflation's gone up so much, my buying power is eroding a lot more rapidly. So what is my only defense? It's the only thing I could do to protect myself. I've got to increase interest rates. So on a similar mortgage amount, instead of getting $2,000 a month, I need $2,300 or $2,400 a month, because what that will do is will offset the more rapid rate of erosion that inflation is causing. And this is why when inflation goes up, rates have to go up. When inflation comes down, mortgage rates have to come down. So I'm going to bring up some slides. I'm going to share my screen. And I believe you can see that now. And we're going to take a look at exactly what this opportunity is and why this is the opportunity you've been waiting for. So we're going to do this step by step. So first of all, let's break down, okay, we talked a lot about inflation just now. What is inflation? Well, inflation is simply too many dollars chasing too few goods. If everybody wants it and few people have it to sell, the price is going to go up. So what the Fed wants to do is destroy demand. It's called demand destruction. So how do they do that? They do it by taking some of the dollars out of the system. Now, what do they do in order to get some dollars out? Well, most of our economy is credit. For every $17 out of them, 16 is credit. So with a keystroke, you could create money. Just like when a family goes to purchase a car, they sign and they drive the car away. They didn't spend any money, but yet they got credit. So the seller got $50,000. So boom, with a keystroke, $50,000 got pumped into the economy for that family to get that car and drive off with it. So now that seller has $50,000 more. So we are seeing money created from credit. As I said, for every $17, 16 of them is credit. So the Fed wants to reduce that. So how do they go about reducing that? Well, what the Fed does is they hike the Fed funds rate. And while it doesn't affect mortgage rates, it does affect car loans. So that family that was going to buy that car for $50,000 with a payment of, let's say, $600 a month, that's when the Fed funds rate was back at zero, and they might have been paying 1% or 2% for that car loan. But now, Fed funds rate's already up to 3.25, and maybe it's going, well, it's for sure going to go to 4.5. Maybe it'll be above that by December 14th. That'll be the next two Fed rate hikes on November 2nd and December 14th. Well, when that happens, that car payment might be $1,000 a month. So that family may say, well, you know, at $600 a month, I was going to do it, but at $1,000 a month, maybe I'll keep the car half for a little bit longer. And that magic keystroke doesn't happen to create that $50,000. And for businesses, it's really big too, because businesses, they're borrowing big money. So maybe they were going to build that factory when rates were cheap, but now they won't because the math doesn't make sense. Maybe they're going to acquire that company, but now they won't because the math doesn't make sense. So what the Fed does is they hike rates and they pull money out of the system because they make it more expensive to where it makes sense, or maybe they don't qualify. But they also are giving us the opportunity to save money now, aren't they? Because remember when you couldn't get a risk-free rate of return? Well, today, even a 6-month treasury, 1 year, 2 year, they're all paying over 4%. They're going to be over 5% after the Fed hikes a couple of times. Now think about that. You can get that risk-free. The price isn't going to change because it's short duration. You're going to get your money back. It's backed by the full faith and credit of the U.S. government, and 5% is going to look pretty darn good. So they hike rates, and instead of spending it, people save it. That pulls money out of the system. Now, you remember all those COVID lockdowns, all the ships out of China that weren't flowing goods, the supply chain disruptions because of COVID. Well, that's really started to ease, and it's really started just recently to where now shelves may be overstocked with goods, and you could actually see some price reductions. So more goods, less money. We are seeing inflation begin to show the signs of coming down. Now, the problem with that is that in the real world, inflation can be coming down, but the way the Fed looks at it, it weights it over the past year, and that causes the actual what the Fed's seeing to be lagging what's happening in the real economy today. Now, I mentioned that the Fed funds rate is something where they're going to determine it based upon inflation and use it to fight inflation, but they admit that they don't understand inflation. You know, we now understand how little we understand about inflation. I mean, that's kind of scary coming from our Fed chair. And it's important to understand inflation because it drives mortgage rates, as I said. Now, I mentioned that to you, that mortgage rates follow inflation, but let's see it in real live action. So the bottom line here is inflation. And as you can see, inflation started moving up here in 2018. And as a result, mortgage rates started going up in 2018. But then inflation started calming down, and mortgage rates calmed right down too and followed suit and went lower. Mortgage rates went flat, so did inflation went flat, and so did mortgage rates. And then during COVID, inflation really dipped, the economy really slowed down. And so what did the Fed do? they started quantitative easing. They were buying lots of mortgage-backed securities and treasuries. And what they did was they kept mortgage rates. You can see here, this is the 3% line for mortgage rates. They kept them right around 3% for a long time. But something was happening. You see, inflation started to move up pretty dramatically, but the Fed didn't do anything. They kept right along buying QE, keeping rates at zero when they should have been hiking rates. They thought it was transitory. And then inflation really took off. And under tremendous criticism, the Fed finally started to take action. But you know, the reason why you've got 7% rates today is because the Fed was very lax. It's just like a patient. If the patient gets an infection, maybe you give them some antibiotic pills and in a couple of weeks, they're fine. But if you let it go for a long time, you need major surgery. Well, if the Fed would have responded to inflation here and stopped QE, okay, maybe rates go up a little bit, maybe they hike rates a little bit, but you get inflation under control and we'd be okay. Now you need the major surgery. And that's unfortunately what they have to do. Now, it's not just the Fed. Our government, in an inflationary environment, started pumping stimulus. I'm not going to say, you know, from a political standpoint, right, wrong, whatever, but you know, pumping stimulus in an inflationary environment is simply inflationary. Now, once the Fed stopped with QE and stopped fixing mortgage rates roughly at 3%, well, then mortgage rates did what they always do. They follow inflation. And as inflation rose, mortgage rates rose. When inflation kind of eased a little bit in the summer, in the early summer, mortgage rates eased as well. But as inflation started to take off again in late summer, mortgage rates followed suit. And that's kind of where we are right now. So if we want to understand when mortgage rates are going to come down, which will really help the housing market, the question is, when is inflation going to come down? So let's see. This is how you look at inflation. Now, there's two ways to look at it. There's the Personal Consumption Expenditure Index, and there's also the Consumer Price Index. Now, the Consumer Price Index, or CPI, comes out before the PCE, so it gives us a little more up-to-date, newer information. So we're going to look at the CPI. The CPI has a headline number, and then they have the core rate of inflation. Now, the Fed wants to only look at the core rate of inflation. So what is the difference between the two? The core rate strips out food prices and energy prices. So, you know, people might scoff at that and they might say, well, you know, hey, we need food and energy, don't we? So why would you omit that? Well, it kind of makes sense why they omit it, because what the Fed is saying is they said, listen, we only want to look at what we have influence over to determine the monetary policy that we're going to have. So food prices are oftentimes determined by the weather. The Fed can go and hike rates or cut rates, not going to change the weather. And energy prices have other factors. You know, if there's an oil embargo, if there's a pipeline disruption, if OPEC cuts or adds to production, the Fed can do all the hiking they want or all the cutting they want. It's not going to change that. So they say, let's just look at the core rate of inflation. And the core rate of CPI right now on a year-over-year basis is 6.6%. That means things cost 6.6% more than they did last year outside of food and energy. So how do we get this 6.6%? Well, this tells you year over year, which means that it is actually made up of the most recent 12 individual months of inflation data. So each month has how much it went up month over month. So if you add up the most recent 12 months, and the latest data that we got was September of 2022, so you take September 22 and you take 12 months and go back to October 21, you add all these up, account for a little rounding and compounding, then you got 6.6%. There you have it, nice and simple. So now this can give us a lot of clues. Now, anybody that's listened to some of my talks, I know I've done some talks for guaranteed rate throughout the year, and I remember telling the folks at Guaranteed Rate and the people that they brought in, their realtors, that while a lot of people were saying in late spring that inflation's peaked, I was saying, no, it's going to be a cruel summer. And we brought this up to all our subscribers and we said rates are going to go up over the summer and it's going to be brutal. It's going to be a tough summer. We're going to get a lot of heartburn. That's all the things that I've been talking about. And sure enough, we did. Why? So how did we know that? Well, we know that inflation drives mortgage rates, and we felt that the year-over-year rate of inflation was going to go up to from 5.9% to a rate much higher than that. So how did we know? Because we looked, this time it was looking ahead, and we looked at what July, August, and September's readings were going to be, and we looked back and we said, boy, While we don't know what July, August, and September's inflation numbers are going to be for 2022, we know they will be replacing very low numbers from 2021. These numbers are quite low. So we said it wouldn't take much to go above this and see mortgage rates rise. And that's exactly what happened. If you take a look July, we didn't get much movement because the July of 2022 number replaced the same number that it was in 2021, so not a big difference. But then August came, and August was up 0.6% for the month. It replaced 2021's number, which was only up 0.2, and the inflation reading went from 5.9 year over year to 6.3. Then we got the September reading. And by the way, when that happened, mortgage rates started to go up a lot after we got that result. And then earlier this month, we got the reading for September of 2022. That was also up 0.6%, and it replaced a very low reading of up 0.3%. And we went from 6.3 year over year to now 6.6 year over year. And that's why mortgage rates have behaved so badly over the last couple of months, because inflation on a year over year basis has jumped up dramatically. But now some good news. Well, we already know, we talked about this, that goods are starting to flow. We already talked about the Fed hikes will slow things down, and they're starting to. And November 2nd, there's another Fed rate hike. And December 14th, there'll be another Fed rate hike. So we know things are going to be slowing, and that'll take away pricing pressure and bring down inflation on the new readings. But we also now can see that the new readings, which should come in at lower numbers, will be replacing elevated readings for the latter part of 2021 and the first half, even the first 3 quarters of 2022. So we're going to get lower inflation readings replacing higher inflation readings. This year over year number is going to come down, 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 down. Now, it may take some time to get there, but we really believe that you're going to start to see rates get close to 5% or around 5%, maybe with a little luck under 5% in the first half of 2023, pardon me. You should see that happen the first half of next year. Now, a lot of this is shelter costs. The cost to put a roof over your head. How much? Well, 39% of core CPI is shelter. And there's a problem with the way that they look at shelter, in that it lags. You see, we know that in real time right now, shelter costs are decelerating. So we know that it's coming to a less of a influential level in pushing the CPI higher. But when the Fed looks at it, they look at it on a lagging basis. So they're getting this tail end when it was going up to be reflected in the actual CPI numbers, 39% of it. Kind of reminds you this pattern here, like a roller coaster. When the roller coaster reaches its apex, and the middle of it is at the apex, remember you going up a roller coaster, tick, 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 then you get to the top of it. The front of the roller coaster is actually heading down, but the back is still on its way up. So in the real world, where we are today, shelter costs are starting to decelerate, come down. But the way it's measured in CPI, it's still propping it up. When we get to January of 2022, we will be like through the snake here. We will be where you see this fully decelerating. And that should give us a more rapid drop in CPI. So we'll start to get some relief with the next CPI report. That comes out November 10th for October. But after we get the January number, that'll come out the beginning of February, you'll really start to see it come down. And I think that's why the first quarter of next year is looking very good to us as far as improvement, big improvement in interest rates, and probably get to around 5%. So this is a great opportunity for us for many reasons. Now, I'm going to show you a lot more about the housing market and where we're headed, but I want you to think about how this is piecing together. You can now negotiate a better price on real estate. A year ago, I had to pay you $50,000, maybe more than asking price. No terms either. Forget about a home inspection, maybe not even an appraisal. So I had all cards stacked against me as a buyer. Now it's more normal. I can actually negotiate. I could get a better price. I could get some terms I want. And guess what? I can get you to pay for my 2-1 buy down. So think about it. I get my 5% rate now. Next year I refinance and I keep a 5% rate for the rest of the term. And to pay for it, I get a refund because remember, on a 2-1 buy down, you're going to get a refund because the second year's interest is prepaid. So you're going to get that back. That'll pay for your refinance. Because remember, you bought it down 2% the first year, 1% the second year. You're not going to use it the second year. So you're going to get that refunded to you. And now I'm going to buy the home of my dreams with the rate I want at a discount. And then when rates get to 5% next year, we already know it's a tight inventory environment. I'm going to show you how tight in a minute. When all the buyers come back out, guess what happens to real estate values? But you got to be smart, and you have to see the future before it becomes obvious. That's what we try and do every day at MBS Highway, is see the future before it becomes obvious. You have to see beyond the headlights. Very few people gain the benefit of opportunities because they're so focused in the rearview mirror like the Fed, or so focused in just seeing what's in front of them and not seeing what's ahead. Wasn't it Wayne Gretzky, perhaps the greatest athlete of all time, when you look at compared to what he did compared to everybody else, who said, I'm not going to where the puck is, but I'm going to go to where the puck is going to be. Where the puck's going to be here, where the market's going to be here, is lower rates next year with higher prices that you can take advantage of getting a discount on in the future right now. There's another aspect of it is money supply. And we know that a lot of excess money has been sloshing around, but it's already flattened out and it should begin to decline. It's actually declining slightly. It's the first time it's been declining since 2004. So we're seeing that benefit. One of my mentors, Lacey Hunt, who is in my opinion, one of the brightest minds in the bond market, he expects this to neutralize in March. And therefore, we should start to see the benefit of this, even pushing inflation down further. So folks, everything is in our favor here moving forward to see lower rates, which will juice the real estate market. And you know what? Even the bond market believes that. The smartest investors out there, they believe it because you can't get a 0-point loan. So how does that tie together? Well, think about it. A 0-point loan for a customer, I know people call it par, but it's really not par. Par means it's being sold at par, equal value. It's not sold at par because then if the customer's paying 0 and investor's not paying above what the value of the loan is, then how are you getting paid? So that can't be. A $500,000 loan, if the customer's paying 0, then it's got to be sold for more than that. So it's got to be sold for $510,000 to an investor. So why in the world would somebody pay $510,000 for a loan that's only going to give them back $500,000? Well, because they're getting a higher yield than market rate. So it's an addition above market rate, maybe 0.75%. So they might like that and say, hey, look, if I keep this thing for a couple of years, I'm making money. And if they stay in this home for 6 or 7 years and don't refinance, wow, I made a boatload of money. But guess what? If it pays off earlier, they lose money because they're only going to get back $510,000 if the loan pays off in 6 months or 8 months or a year. Well, they've lost money on that. So they don't want to do it. So what they're going to do is make it painful or try to discourage you from doing that by either not offering it or making it extraordinarily expensive or painful. But what this means, if you read between the lines, is the smartest money out there is agreeing with us and saying that rates are coming down and all these loans are going to be refinanced. Now the Fed, they're fixated in the rearview mirror. This is Loretta Mester. She is a Fed president from Cleveland. She's a voting member this year. Fed presidents, except for New York, rotate. There's 19 Fed members, 12 of them vote in the Federal Open Market Committee. Those are the voting members, and they vote on something really important, the most important price in the world, and that's the price of money. It's the Fed funds rate, what to do with it. And she says, like many Fed members do, that we've not seen any progress on inflation. We need to bring interest rates up through this year and into next year. Monetary policy needs to become more restrictive, means higher rates, to put inflation on a sustainable downward path. She just said this a few weeks ago. But because she's looking in the rearview mirror. See, inflation's already coming down, but she's driving forward, very dangerous, while focused on what's in the rearview mirror because she's looking at lagging indicators. And to prove this, let's take a look at what she said just last year. Now, just last year, inflation, as you saw in that chart that I showed you, was on a tear, much higher. But because it lags, what did she say last year? I'm not concerned with inflation running away. I'm not worried about inflation getting out of control. The Fed needs inflation to rise. By the end of 2021, She expected inflation to be between 3.5% and 4%, and she expected inflation to drop in 2022. Again, she just said this a year ago, folks. Think about the flip-flop that they do. It's because they drive while looking in the rearview mirror, and the policies that they set take time for it to be in effect. So you're making decisions based on the past on things that will take time for the effects of it to be felt in the future. It's terrible that they don't adjust. And that's why they always lead us into recessions. Every time the Fed goes on a rate hike cycle, these shaded areas are recessions. Look at the last 70 years, again, over and over. Every time we're right here, rates are going to go up at least another 125 basis points. So we're going to be up here and we'll be in another recession if we're not there already. Now, when you think about interest, what is interest anyway? Well, interest simply is the price of time. Well, what do I mean by that? If you have money and I want to borrow it and you let me borrow it, then think about it. I get to enjoy it. I could do what I want with that money. I could have a party with it. I could buy stuff with it. I get to enjoy that money, but you can't because you've let me enjoy it. Now I do owe it back to you. If we go out to dinner and we're there at the dinner table and I say, oh, goodness gracious, the bill comes. I said, I forgot my wallet. Could you lay it out for me? And as soon as we get back, I'll go ahead and reimburse you. You're probably not going to charge me interest. But if I said, hey, can you lend me $50,000 for 10 years? That's a long time. You're going to probably want some interest for that, right? So interest is the price of time. The longer you want to borrow it, the more compensation or interest I need, which is why a normal yield curve looks like this. Shorter time frame, lower interest. Longer time frame, higher interest. That's normal. But when the Fed hikes rates, remember, the longer side of it cares about inflation. The shorter side of it cares about the Fed. So as the Fed props up the shorter end, these go up, up, up. The longer end's worried about inflation. As the economy falters and inflation winds up coming lower, it's thought that money in the future might buy more than it can buy today. So the longer end of the curve goes down and the shorter end of the curve goes up, and the yield curve gets inverted. When that happens, it leads to recessions because it's showing that the Fed's raised too much and the economy is too weak. And you see this red every time they've inverted, and every time it leads to recessions over and over and over again. And I'm going to explain to you in a minute why recessions are so important to us and to the housing market. This is a Fed governor. Now, Fed governors vote every year. Those Fed presidents, they rotate, but Fed governors, there's 7 of them, they vote every year. And his name is Chris Waller. And he says, what, recession? I don't know. I don't see a recession. How could we have a recession with a 3.5% unemployment rate? The job market's too strong. And a lot of people say the same thing, and it's a mistake. Because when you look at history for the past 80 years, what you'll see is that recessions don't start when the unemployment rate is high. When do recessions start? When it's at its lowest level and starts to tick higher. Let me show you. See, Mr. Waller would benefit from this chart because you could see over and over and over and over and over again, recessions begin, the shaded areas, when inflation reaches its lowest level and starts to tick up, then you get a recession. Lowest level starts to tick up, lowest level starts to tick up. That's when you get recessions. So why? Why does that happen? Well, it's easily explained if you understand it. So here you go. When business is good, job market's good, you're growing, you need to hire more people, you start hiring people. So people that were unemployed get hired and the unemployment rate starts going down, 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 down. But eventually the cycle turns. And so as businesses slow down, one of the first things we do, and you know this all too well, is you have to start unfortunately letting people go. And as you do, the unemployment rate starts to tick up. And that's the first warning sign. Because then what happens, if you think about it, is those individuals that are now newly unemployed, they change their spending habits. They hunker down. They don't spend as much. And the businesses that used to count on them for their business, they see the slowdown because those people aren't shopping there anymore or buying stuff from them anymore. So now they have to let people go, and the cycle perpetuates itself again and again. And that's why you get this phenomenon that leads us into recessions, and the unemployment rate shoots up after that because it just becomes like a cycle. And here's where we are right now. Now, you don't have to be a mathematician to see that we're kind of pretty darn close to the low levels where recessions tend to start, if we're not in a recession already. But the Fed doesn't see it. They say it looks like a soft landing. That's code for no recession. And maybe the water in front of you looks calmer. But if you look further than the hand in front of your face, you could see that there are some problems ahead. So why do we talk about this? Here's why. Because it affects mortgage rates. During recessions, mortgage rates decline. The last recession went down by 1% and then more than 1% during the one before that, and then a lot more, near 1% and then a lot more, 2.25% and then more, 5%, 4%. Mortgage rates go down during recessions. That's the main driver here that I want you to understand. So everything we're talking about here, this opportunity, rates are going to come down. And as they come down, this is going to drive a lot of buying activity, because while people may be hesitant to buy a home now with 7% rate, at 5%, it's going to start to look really darn good. But you want to be ahead of that. And what the beauty of it is that you can buy and get the 5% rate down, because you get the seller to pay for your 2-1 buy down. So what about housing? Oh, it's a recession. It's got to be bad for housing, right? Well, that's not what history tells. History tells us that in the 9 previous recessions, home values went up in 8 of 9 recessions, except one, the Great Recession here. But if you look, it was housing that started to peak and bubble that led us into the recession. It wasn't the recession that happened and then it caused housing prices to drop. So why did this happen? Yeah, it's true. We had pay option arms, negam, no income, no asset, no job, 580 FICO, nothing down. Yeah, of course, 100 LTV, not good. But at its core, just like anything else, it was driven by supply and demand. Everything in economics, every price is determined by supply and demand. And there was just too much supply and not enough demand. So how do you measure supply in housing? Well, that's builders putting up homes, completing homes. And there were a lot of them. In 2006, builders put up 2 million homes. But at the same time, households being formed, that's how you measure demand, dropped way down. So what is a household formation anyway? Okay. Imagine a family, mom, dad, and a child, and they live in a dwelling. I mean, apartment, could be a house, whatever it is. Now, that child grows up, and at age 33 is the average, they move out and get their own place. So now it's the same family, mom, dad, and a child, but instead of having one home or one dwelling that they live in, now they need 2. They have formed a household. And in the United States today, we're forming 1.7 million households. But back in 2006, let me show you where we were. Take a look. It was like 1.7 million households in 2005, but we got to 2006 and it dropped suddenly below 1 million and then went to like 500,000 in 2007. So what the heck happened here? Why did households, the blue line, drop so bad? And all at the same time that builders put up more homes, 2 million of them, than they ever have in history, even till today. What the heck happened here? Well, maybe what we should look at for clues is, did something change in the birth rates between this period of time? So let's go back. That we said that average age is 33 years old. So let's go back 33 years and see when these people were born. So 2006, 33 years before, that's 1973. And let me show you the birth rates. And here they are right here. Wow, isn't that interesting? Huge drop in birth rates. Then it went down further, stayed low, and then started to climb. Huh, doesn't that look a lot like what happened 33 years later? Huge drop in formations, went down further, stayed low, and started to climb. Isn't that incredible? Yeah, because those people were born 33 years earlier, and now they're coming of age. There's a reason for it, by the way. The reason why birth rates had dropped so much. And again, I'm not going to say this without any political or without any kind of other meaning other than what the fact was. So I'm not against this. I'm not saying anything. I'm just saying that the reason for the big drop was because in 1973, in January, abortions were legalized and birth rates dropped at that point in time. As a result, 33 years later, you had fewer people forming households. And now you could see birth rates, in the 80s and in the early 90s, they were really climbing. And that's the generation of people today that we're looking at now. In 1988, 89, this will continue to climb. So that means more demand going forward. If you want to know why the housing market's been so strong, why inventory is so tight, well, look at this. You have more demand than supply. It's that simple. More people want to buy, then there are homes available. Home values are going to be well supported. Now, I said we are at about 1.7 million households. The latest data is 1.77 million. But you can see here, it's in this range of 1.6 to 1.8 million, a fair range to be in. That's demand. Well, what about supply? Builders are only completing 1.4 million, and every year they got to rebuild some of them. So maybe we're netting 1.3. And they're hesitant to build more because they learned their lessons from 2006 to 2009. So what is this telling you? That we are in and will likely remain in a tight inventory environment. You turn on the spigot of buyers when interest rates come down a little bit, and they will. And what's going to happen to home prices? You don't have to, look too deep. There's going to be more demand than supply, and home prices will probably do well. But that's not what the media wants to tell you, because good news doesn't sell, only fear sells. Now, Diana Olick and many others, they talk negatively about the housing market. She's been negative about the housing market for 10 years. Now she's on 3 times a day, putting negative stories, trying to scare people like she always has for the past 10 years not to buy a home. So how's her track record been of the hundreds and hundreds and hundreds and hundreds of stories that she's put out there, literally, that are all negative about housing? Let me just show you a few to give you a history of what the media tries to do. So in 2015, 7 years ago, she said, we're in a housing bubble larger than 2006. But we weren't, were we? No, that year values went up 5% or $15,000. So she was wrong. The next year, did she offer an apology? No, she just said, we're in a new housing bubble, don't buy a home. But home values went up again. The year after that, she said, home ownership does not build wealth. Can somebody just point to the one person in the last 5 years that did not build wealth in home ownership? Just one. Okay, so completely wrong again, and home values in that year went up. The next year said, hey, it's better to rent than to buy a home. I feel sorry for somebody who listened to her and rented instead of buying a home, because no one's benefited from that. And home values went up again that year. Then in the middle of 2019, she had this big story, big lead up that she built up to this, and she's warning people, before you buy a home, heed this warning, and that the housing market's about to shift in a bad way. But that warning turned out to be incorrect, as home prices went up yet again the remainder of the year. So at the end of 2019, her forecast for 2020 was, don't buy a home because it's going to be hard on the housing market. You should be renting. Well, it's only hard if you didn't buy a home, Diana, because values went up $60,000 more, 16%. And then about 15 months ago, she put out this big cover story saying that housing boom is over. Well, we've gone up 18% or another 80,000 since then. So she's costing people on a $300,000 home close to $250,000. This is what the media does. They sell fear. If you really want to take a look at facts, well, let's make some comparisons. You think that in 2007, you want to compare it to that? Well, we had 4 million homes in inventory. Here's where we are today, folks. The most recent data from the this is from the National Association of Realtors, and we have 1.25 million units in inventory, less than a third of what's available. How are you going to have a bubble? Now, somebody might point to the fact that, yeah, but it's really gone up a lot so far this year. If you look between April and most recently, we've gone up dramatically from like 900,000 homes in inventory to 1.25 million. That's a huge increase. That's a bad sign, isn't it? And they'll just show you this and try and scare you. Well, what if I showed you the same chart, but instead of looking at just 1 year, see if you notice something if I show you 10 years. You see a pattern? Yeah, that's right. This happens every single year. Every single year, you get this big move up, and then it crests and goes down. So why does this happen? I'll explain it. Remember when you were a child and someone new came into the school class in the middle of the school year? It wasn't easy for them. It wasn't easy to get caught up, and then kids can be mean too. So parents know this, and they want their kid to start at the beginning of the school year. So what do? They say, well, if we're going to move, we got to be in that home over the summer, June, July, or August. So if we're going to be moved into the new home June, July, and August, we got to sell the old home when? April, May, June, July. April, May, June, July. Same thing with a little COVID distortion here, but April, May, June, July. April, May, June, July. Every single year, over and over and over. That's why it happens. And you can already see it's starting to crest. Now, while there is 1.25 million units in inventory, that's not right either. Let me show you why. Because what's counted in that, get this, you ready? Our home's under contract. That's right, that home under contract. Yeah, you think that realtor is going to take the client out and say, hey, listen, let's knock on these people's door. Let's see if they'll let us see their home. It's already sold. They're closing next week, but let's knock on. No, they're going to call the police on you, okay? No, you can't count this. You have to take it into consideration and only look at active listings. This is what you can buy. There's 732,000 homes available in a country of 340 million people. And this gives you that same look, but now with active listings. And sure, inventory is a little higher. Well, rates are 7%. What do you expect? But it is still near historical lows. Except for 2021, this is the lowest level of inventory ever, even at the low points. And this will come back down too. Now, normally 25% of home inventory is under contract. Today it's 41%. Most recent data shows homes are selling in 19 days. Today, Redfin came out and they showed us that people are getting on final listing price to actual contract sales price, 99% of it. Okay, so homes are stubbornly resilient. But what about foreclosures? Oh my God, CBS Market Watch put this out there. They said there's a dramatic increase. Foreclosure filings are up more than 150%. That sounds really bad. That's scary, isn't it? Well, until you look at a chart. And yes, it's true, it's up 150% from last year, but last year there was a moratorium. You couldn't do foreclosures. If you take a look at it compared to a normal year like 2019, it's down 60%, but the media won't tell you that. It's down over 90% from where we were in a bad year like 2010. But they won't tell you that because that doesn't sell. Fear sells. What sells in the media? You know, sex sells and fear sells. So this is like fear porn. That's what they put out there, folks. And that's what we have to combat. Now, here's a big one too, is affordability. And I want you to pay close attention to this because it is, yes, it is less affordable, but here's where I need you to put on your thinking caps. And I want you to see, let's test you. And let's see if you're thinking about this like the media or like the Fed, or if you could see into the future a little bit. Okay, so last year, a $400,000 mortgage, let's say you're buying a home, you need a $400,000 mortgage, a rate of 3.5% last year. I think it was between 3.3 to 3.5 is the most recent data that we get here. So we're using 3.5%. So it's about $1,800 a month. Now, according to Fannie Mae, not a qualifying income, but the average income people have that bought this or took out this mortgage, it was $9,000 for the household. Great. The media shows you this change and they'll say, but in 2022, we know that prices have appreciated 15%. So you get the double whammy here. You have to pay more for the home, which means I got to take out 15% higher mortgage amount. So when I was able to take out 400 last year, this year I got to take out 460. Okay, well, not only do we have that, but I've got a rate that's at 7% this year too. So my payment is $1,300 a month more, but the media stops there. Is that the right way to look at it? No, because what about your income? Did your income stay the same as last year? Well, the best resource for this is ADP, the payroll company. So they examine, get this, ready? 25 million payroll records. So they got a pretty darn good handle on it. It's an enormous sample size. It's very, very good data. And they said that if you stayed on your job, your income went up 7.8%. If you switched your job, it went up 15.7%. So because more people stayed than switched, they gave an average of 9%. So what did that do to your income? So while your payment's higher, so's your income. So you now see that it's still more expensive, but you have mitigated this to a great extent. But we want to be fair here too, because we can't forget that's costing you more for gas, costing you more for food, costing you more for services. And that's the problem in today's market. Your costs are way up. And while your income's gone up, it's not as bad as the total cost. You've cut that kind of in half, but you're still kind of $700 a month more expensive. And that's the problem today. But let's not stop here. Let's not be like the Fed. Let's be able to see beyond the headlights. So if we start to look forward, I fixed this payment, haven't I? If anything, I could refinance it and bring that payment way down next year if we're right, if rates come down, and they sure should come down. But let's assume that they stay the same and you don't refinance. Okay. What about your income? If we listen to ADP, and ADP says your income is going to go up 7.8% if you stay on your job, well then, your income is now completely negated the additional affordability issue in 2023. Folks, you have so many tailwinds. What an opportunity to see through it, to buy now, to get a deal. Warren Buffett said, you want to be greedy when others are fearful. Now's the time to be greedy. One of the greatest investment minds ever, Sir John Templeton, he said, you want to be a buyer on the most pessimistic day. There's a lot of pessimism there, but here's the opportunity. All these things that we're showing you. You need to do this because real estate creates wealth. You have leverage, and you folks provide the leverage that allows people to do it. Now, historically, real estate values have gone up, between 4.5% and 5%. So let's just keep 4% in mind for a second. On a $400,000 purchase price, what if we only went 4%? Is that good? Well, let's see. If I put 10% down, my investment's $40,000. So if the property goes up 4%, I made a profit of $16,000. A $16,000 profit on a $40,000 investment, guess what that is? That's a 40% rate of return. Now, I know some of you might say, well, what about the payment? Well, what are you going to do? You're going to rent, you still got to make a payment, right? So payment to the cost of living payment you make, but the return is how you get wealthy. And you get wealthy. We all want to get wealthy, right? So net worth. Here's a fun exercise for us. Kiplinger's released this just recently, and here's the thing. Kiplinger's, they tell us that if you want to be in the top 1% in the United States, the top 1%, how much net worth do you need? What's net worth? All of your assets minus all your liabilities. Everything you have minus everything you owe. You need $10.8 million to be in the top 1%. It's a big number. Okay, what about the top 2%? That's a pretty exclusive club right there, isn't it? Top 2% in the country? How much do you need? $2.5 million net worth. How about in the top 5%? Rarefied air, for sure. Top 5%, you need $1 million. And to be in the top tier, that top 10%, you need 800,000. Top 50%, 500,000. So while this is fun to look at and see where we stack up, what's amazing about this is what they said is, get this. On average, 2/3 of this net worth, 2/3, where'd it come from? Home equity. You want to be up here? It's a lot harder to do it if you're renting. You need to be purchasing homes. This is how you create wealth. And now's the time to take advantage of it, where you could buy and negotiate, have your cake and eat it too as far as rates go. Our housing forecast is for low single-digit appreciation. Now, some markets, look, if you're in Seattle, San Francisco, San Diego, maybe Phoenix, if you're in Los Angeles, if you're in maybe Austin, if you're in Denver, you have seen astronomical appreciation. So would those markets maybe come in a little bit? Yes, 5, 6, 7% after a 60, 70% run up. Yeah. But most of the country, you'll see relatively flat, low single digit appreciation, maybe come down 1% or 2%, but overall pretty darn good. But over time, you'll see closer to 5% on average, because a person's not going to buy a home and move in a year. That person, over the 9 years that they're going to live there, they're going to get more than 5% on average annual return. And part of that's rents. It's going to pressure it up. Rents are going up 13% a year on new rents, 8% on renewals. Now, one of the things I'm going to suggest that you consider doing is, I'm part of this show, Financing the American Dream. Now, I don't have a financial interest in it, but I do the opening for them. And it's Emmy Award winning. They do it so well. It's on CNBC, it's on Fox. And I open up kind of as the host. And what I do is I talk about a lot of the things that you just heard me talk about, where I talk about what's happening in the marketplace and important things for individuals to look at. And I'll be on different locations doing it. But then the show shifts after my first opening 6 minutes or so. It shifts to local markets with a local host. And that local host talks about their market. Well, they'll feature real estate agents and individuals. The reason I bring this up is because I talk to a lot of these local hosts. We get together and they're crushing it even right now. Because think about it. What if you went to a realtor and said, hey, would you like me to feature your listing on CNBC? You don't think that realtor is going to start giving you business? Of course they are. So what I really would like you to, and if those of you that are part of list reports, you know that you get matched up with realtors who are doing business, you can target them. I mean, it's like It's a perfect combination with list reports. So if you would like to do this and apply, because a lot of markets are taken, if you would like to get a market and apply for it, I think it's a really good idea. I'm bringing this up to you as an idea to win in this market and gain market share. Scan this. You can't take a picture of it. You got to scan it on your phone and then go to the website and apply for it. Now, a lot of people are worried about the market, so they're choosing to rent, even though that right now purchasing would be a much better idea. So let's do a quick analysis, and you folks have access to this on MBS Highway, and you can certainly share this with your real estate agent. So your real estate agent really needs you today to help them and see these opportunities so they could share it to their customer. So here's what we do. Purchase price, $400,000. Loan amount, 10% down, so it's $360,000. Let's take a 30-year fixed rate of 7.5, way above where the market rate is now, right? And they think they're going to be there for 9 years, and we just pick the average that people are there. Okay, so there's some more negatives about buying versus renting. Let's throw out all the negatives. What are they? Well, property taxes go up about 2% a year on average, not every year, but the average is 2%. And then $400,000 home, it's going to cost you $2,000 a year in repair, so that's about $166 a month. And then the cost to sell, you don't have to worry about that as a renter. 6% of the appreciated value in the future. And if we take a look at the last 63 years, 4.5% appreciation, let's use that as a benchmark. Okay, that's through quite a few housing bubbles too, right? So yeah. So as we take a look at these numbers and we compare it to renting, you know, a $400,000 home, how much can you rent it for? It's going to be over $3,000 a month. But let's make it look pretty. Let's say you're getting a steal on the rent. Oh man, it's too good to pass up. I'm going to rent below market. And while the national average today is rents going up at 8%, the landlord likes me. He's only going to move my rent up 6% a year. So that's great. Is it better to buy or better to rent? Well, if you look at the payment, you might say, wow, renting's a lot better because buying's $3,500 a month, renting is $2,700. Heck, I should be renting, right? Well, remember that rent's going to go up. And by the 5th year, you're paying as much for rent as buying. And then when you think about the future, you're going to be there 9 years. Over the 9 years, you paid about the same. Or did you? Because one of the main things you have to show your customers, not all of this payment is actually a payment. Here's what I mean. When you look at monthly principal and interest goes to the lender. We all know that, right? The bank, the lender, that's where their interest goes. But who does the principal go to? That's not a cost. That's your own money principal. Look, here's an example. I have cash in my left-hand pocket. If I take it out of my left-hand pocket and switch it to my right-hand pocket, is it still my money? Of course. When you are about to write the check to the lender for your mortgage payment, it's sitting in your checking account, that money. When the lender cashes it, the principal portion is now in equity. Is it still your money? Yes, it's just in a different location. And it's a lot. In this example, it's $41,000. $41,000, folks, okay? Now, how about appreciation? Well, historically, it's at 4.49%. By the way, the forecast is 5 and change percent, but we're going to just go with the historical for 63 years, 4.49%. Let's be conservative. What is 4.49% compounded annually on $400,000? That's not easy to do, right? Not easy for you, for your client, for your realtor, which is why you have to show it to them, because after all, Albert Einstein said compound interest is the 8th wonder of the world. And here's why. It's $194,000, just 4.49% compounded annually for 9 years. That's why so much wealth is created in real estate. So much net worth comes from home equity, folks. Look at these two things. You've got $235,000 in home equity creation. You don't get that renting. You also get a little tax benefit, but you do have the cost to sell at time of when it's time to sell it on the future value, 6% of the new value. Put it all together, and at the end of the 9 years, you've got an extra $205,000 better than renting. And that's not even considering what if you refinance next year back down to 5%. What are you going to have, $275,000? And gosh, so much better. If you stay there longer, you make more. But even if you stay there for a shorter time, you do pretty darn good. Is it bad to make $93,000 in 6 years? Is it bad to make $38,000 in 4 years? Look, I tell the customer, if you're going to be there less than 2 years in this environment, rent. But if you're going to be there longer than 2 years, why would you not buy the home? Well, I don't like the way 7.5 sounds. Well, do you like the way 15,000 sounds, 60,000, 100,000, $200,000 sounds? You're going to miss that because you don't like the way 7.5% sounds? Isn't that silly? You have to show it to them and share it with your realtor. Co-brand it. You have access to this in MBS Highway. Just do it. Why would you not? Why would you not show this to everyone? Why would you not get more business from realtors by putting this in every single one of their open houses? Why would you not? It takes you 3 seconds to pull up, and what's the return that you get? Enormous. Investment properties. Did you know that 1 out of every 6 transactions is an investment property? 1 out of 6. If you're not doing it, you're missing 1 out of 6 deals. If you don't teach your realtor to do this, they're missing 1 out of 6 deals. The thing of it is that real estate investors don't have any good tools to analyze it. None, zero, which is why we created it. The only one that have it. But Guaranteed Rate has access to it. So here it is. Purchase price, $500,000. They put 25% down, 375 mortgage, 7% in 1 point, let's say. They're going to own the home for 10 years. They got the cost to buy. They got the repair cost on average per month. They've got property tax increases and the cost to sell, and the forecasted average annual appreciation going forward is about 5.4%. Now, how much rent can they get for this $500,000 home? About $3,500 a month. The year-over-year rental increases, I know that we're at 8% a year now, but let's just say you only get 6%. And the current vacancy rate on average in the United States is 4%. So we'll use that. Factoring all these in, vacancy, all that stuff in, let's take a look. In year 1, you're going to lose a little money. Yeah, about $350 a month. But by year 10, you're making $76,000. What's your cash on cash return? 54%, not too shabby. But what about the big money? Yeah, appreciation, $352,000. That's just 5.4%, folks. Amortization, $53,000. Let's put this on a little spreadsheet here. So what you show your client is, hey, okay, you got your rental income, $531,000. That contemplates, that already considers the vacancy. Appreciation, $352,000. So you're going to bring in $880,000, but you got expenses: interest, property taxes, insurance, repairs, closing costs to buy and sell, $468,000. Well, you made a profit of $415,000. Now you made an investment of $125,000. So what was your rate of return on it? 332% over 10 years. Now, what is that per year compounded? Well, obviously don't take this and divide it by 10. That's not compounded. The compounded rate of return that you got on an annual basis each year is 15.8%. 15.8%. Money managers, the best of the best of the best, Hall of Famers get 15%. This is why real estate is such a great investment to make. And now is the opportunity that you've been waiting for. Don't miss it. Don't let your customer miss it. Don't let your realtor miss it, because the media is trying to sell advertising and sell fear. Now, by the way, you want to help your realtor? The next time they go on a listing, pull the AVM in MBS Highway, the MB estimate. What a great presentation at that listing to show the AVM. What a great thing to have in an open house. What a great thing for the realtor to have at their fingertips to show prospective buyers. Here's the appraisal. Here's all the comps. Do the work for them. Here's their location. And here's the trends for square foot, for sales, for activity. Done. And what about a real estate report card? I mean, this is huge. It takes seconds to pull up, but incredible value. And you all have access to this. Just use it. Show this to your realtor. Co-brand it with them. Because just put in the MLS number or just the zip code, and you'll get the historical and future appreciation. And you can see what it does to the value of the home. You can see the demographics, you can see renters, you can see how many household formations, how many homes builders are going to put up, the shortage, you can see affordability, unemployment, income, jobs. Your realtor needs you to help them right now. Your client needs you to show them right now. And if you do this, you set yourself up for exponential growth right now. When the market was crazy, everybody was benefiting. But believe it or not, this is the market you want, because this is how you can distinguish yourself and set yourself apart. Exponential versus linear growth is what you want. Look, if I took a penny and doubled it every day, 1 cent, 2 cent, 4, 8, 16, 32, 64, at the end of the week, I got 64 cents. But what if I started a week earlier? I'd have $82. If I started a week earlier, I would have had 10,000. What if I started a week before that? I'd have 1.3 million. If I started just 2 days before that, I'd have 5.3 million. 1 day before that, $10.7 million. What's the lesson here? The lesson is don't procrastinate. Procrastination is a thief. You think a guy like Shant procrastinates? one of the best implementers you'll ever see. Successful people don't procrastinate. That's an important lesson to learn, because that's what creates wealth for you. That's what creates exponential growth. Use these tools, get this message out. Listen, let me ask you something. After what you've just listened to, imagine a real estate agent. We're talking to a customer. Wouldn't almost every real estate agent wish they had Barry, me in front of them to explain why they should buy? Wouldn't every real estate agent love that? Well, don't make it me, make it you. You can now do that. Practice. Practice in front of a mirror. Practice with each other. Read. Get the tools. Become a certified mortgage advisor, for goodness sakes. Invest in yourself. Do it now. Because your best opportunities didn't pass you because the market was hot the last 2 years. You don't even realize what's ahead of you. Your best opportunities aren't in the past, they're ahead of you. Back in 1899, 123 years ago, Charles Duell, the guy you see in this picture, was the head of the US Patent Office. And he said, and I quote, so let's close the patent office. I said, why, Mr. Duell? He said, we don't need it, because everything that can be invented has already been invented in 1899. Don't think your best opportunities are behind you. Invest in yourself. Sharpen your skills, because your best opportunities are ahead of you. Believe me, I wrote a book about opportunities that, thanks to many of you, helped make it a #1 bestseller. Folks, thank you so much. I'm happy to take some questions. Shant, if you'd like, or Dean, if you'd like, I am more than happy to take some questions and try and see if we can address what people are thinking out there.
Yeah, Barry, that was absolutely illuminating. Really, really tremendous presentation. I did receive quite a few questions, and I've been trying to steadily kind of check off the ones that I know you addressed. Let me just get to a couple of them. And I think one that's really important to us, when it comes to the larger banks, and the last time you and I spoke, I was with a very large bank at the time. But what percentage of the banks in the future, you know, their loyalties kind of ebb and flow a little bit to the mortgage industry. Do you see that changing? Do you actually see some of them just making mortgage more of a service than a real standalone division? You know, kind of tied to the bank account?
That's a difficult one. I mean, that's anybody's guess is how bank is going to you know,
yeah,
change policy.
Understandable. Next one, jumbo securitization market, especially for IMBs. You know, it's been dry, obviously, with the environment that we're in right now. Do you foresee that opening up in the future?
Yeah, when rates come back down a little bit, that market's going to certainly open up. Yeah, of course. Just like anything else, more liquidity will bring more opportunity.
For sure. Second homes and investments, you briefly touched upon that. In terms of the immediate.
Go ahead.
Go ahead. No, I was going to say, the question that came in is, what is the future of that market? Right now, things are definitely, you know, a little tight in that regard.
So second homes is very geographic, okay, and also very demographic. So it depends on where and what it looks like in individual markets, because second home markets tend to, again, as I said, be more geographic and demographic. So that's going to vary quite a bit. So it's difficult to speak to that overall. With regards to investment properties, look, investment properties, in my opinion, present a great opportunity right now. I think that I would be a big advocate. Use the tool that we have to do the analysis, and if it makes sense for you, then absolutely you should be considering investment properties.
Yeah, and someone also emailed a question, you know, how do you set yourself apart in such a tough market? Well, I think that's what MBS Highway is all about. You know, becoming an advisor, using those tools and resources really is how you set yourself apart.
Dean, agree with you 100%. And your knowledge, you know, one of the things we do every day in MBS Highway is we do the morning video. That's 7 or 8 minutes. That's an investment in your brain. And then practice it, script it, practice it. I mean, you want to be the resource in your marketplace. You want to be the most knowledgeable individual in your marketplace. That's how you get market share, because people will go to you. Like I said, imagine that realtor, any realtor, wouldn't they love to have what we just learned to be put in front of their client? And if you put yourself in the position to get your CMA, watch the daily updates, pay close attention, rehearse, practice, you make yourself that resource that every time you talk to a realtor and their client, they're saying, doesn't matter what the rate is. You have to talk to every single one of my clients because this is what they need to hear. What does that do for your business? Just think about that.
Yeah. No, that's absolutely tremendous. Barry, that's all for the questions. Like I said, I've been checking off the ones I knew you already covered. I didn't want to be redundant, but I really can't thank you enough for doing this for us and taking this time to kind of talk to us about, where we're at, where we're going.
It's a privilege. It's a privilege.
Thank you.
It's a privilege. Thanks for all you guys do. Be well.
Thank you so much, Barry, and I hope that we can get you back in the future to kind of see how things have evolved from here. So
why not?
absolutely. Thank you very much.